The boroughs are New York City. The burbs are everywhere else. Real estate is the ultimate game of risk and reward. It's the biggest investment most people ever make. Fortunes are made over a lifetime and lost in a day. And we're not playing with monopoly money. How do you stay ahead? Who's buying? Who's selling? And why? What do they know? We want the truth. You need an edge. Boroughs and Burbs is your secret weapon, giving you the insider knowledge and strategies you need to succeed in the high-stakes world of real estate. From Palm Beach to Palm Springs, Manhattan to Malibu, we press the experts to expose the pain, find the deals, and occasionally predict the future. That's Boroughs and Burbs, Thursdays, 3 o'clock Eastern, noon Pacific. Because everyone can make money in real estate.
Everybody, Boroughs and Burbs 159, the effect of elections on the real estate market. I'm your host, John Engel, and let's see, we'll go right here to, that's our sponsor, Grace Farms. You'll find them at gracefarms.org. Today's episode, everybody's talking about it. There's keeping current matters. How will the election affect real estate? I turn always to housingnotes.com to find out what is really going on. I love his charts. And Jonathan Miller tackled the subject. So we asked him, where is he? Boom, there he is, Jonathan Miller. We asked him to be on our show today and help us through this. Frances Katzen, everybody knows Frances. She is top 10 in New York. I subscribe to the Katzen Report. I'm one of 15,000 followers on social. I hang on every word, and I'm waiting for her next podcast to drop. My big rival in the podcasting universe. Let's see. There's Roberto, my co-host, and here is his newest market report, and he's got some good facts in here. So I think he's ready, queued up to talk about the election effect. Welcome, everybody.
Great to be here.
Roberto, are you excited about this subject? You tackle the market, and you said when I asked you during earlier podcasts, you said that New York has been slow since the spring market.
Well, it's notoriously slow coming into this fall, into an election year. And in my opinion, it's always much ado about nothing, because it really doesn't really matter who becomes president. And it's just this, like, as we're screeching into the next 2 weeks, it's just, people are just, they might be ready to make a decision. Let's just wait. And the moment the election passes, it's kind of, I likened it to passing an accident on the highway. All the traffic just slows down, and you're like, what's going on? And everybody takes a look.
Rubbernecking.
They rubberneck, and then it just gets right back up to speed. And there's no difference. And you're like, why did we slow down? That's what's happening.
Yeah.
Well, let's get into Jonathan Miller. Jonathan Miller, is his intuition backed up by the facts?
Shockingly, yes. No, sure. This is something, I've been in one form of real estate or another for multiple decades, and sort of the rule of thumb was that that an election year sees a slowdown. And I've written about this in the past. I did a study a few years ago using co-ops, because I could go back 30, 40 years. The New York Times reached out to me a couple of weeks ago, and I looked at 3 housing markets in the U.S. I looked at essentially Manhattan, Miami, L.A., and then I also looked at Suffolk County, and which includes the Hamptons on the east end of Long Island. And the numbers were incredibly consistent. Basically, what it shows you, and it's not about price. It's really about sales levels, sales velocity, whatever you want to call it, where sales slow down slightly or modestly sort of low single digit, 3 to 5% in an election year, which would be an even year in the federal election cycle, the presidential and the midterm, and then pop in, in the odd years. And that's exactly what these markets showed. So it's not that sales are dead. It's, during election year, it's just that they're restrained a bit because consumers, when they don't know what to do, or there's a layer of uncertainty they can't get their arms around, they pause. And then we see a release of pent-up demand after the election is over, almost immediately.
Jonathan, do you notice a more acute sensitivity to the lower price ranges than, for example, the luxury or vice versa?
No. I would say, if you pull out interest rates, which, are going to be more impactful as you move lower in price, if you sort of remove the sort of interest rate factors, remembering, I think it's 9 out of the last 11 elections, interest rates fell during a presidential election. So this year is no different than the majority of previous years that have been tracked. There's a pause. I can't say that some elections there's more of a pause at the low or the high end than others. This go around, it doesn't seem to make much of a difference. I would probably say, because rates have more than doubled in a short period of time, the steepest ascent in mortgage rates in the last 50 years, that it skews, the slowdown skews more heavily to the lower end of the market. But it's not this like crazy obvious thing. Think of it as there's a subtle slowdown in activity as people try to process this.
Francis, are people who know this is true, they've watched the last 25 years like Jonathan's watched it, are they gaming the system? Are they getting in during the slump and expecting that the market's going to take off in the spring after the election, after we know the result?
I have a lot of clients that are in finance and tech, and there's no question in my mind that they are absolutely heeding my guidance as we collectively look at the value proposition that's currently available. I also think, for example, 28 contracts were signed last week, and 13 of those 28 were above 10 million. And I also think it's very interesting because Goldman came out with numbers that are redonkulous, and I think that's going to play heavily into it. I think Goldman Sachs reported earnings was supposed to be 12.70 billion versus 11.8, and their stock earnings share went up from $8. It's now at $8.40 instead of $6.89. And Citibank, my client is there. So he's saying it was, the share was at $1.51 versus $1.31, and expected revenue was supposed to be 19.84, and they actually pulled in 20.32. So to me, I think it's going against all these usual factors. And I do think that 50 basis point drop that we saw 3 weeks or a month ago has definitely impacted the entry market, because for the first time in 9 months or 8 months, we had a little studio on the market at 400,000 that had 18 people through the open house, and we got full price. So to me, that is the most protracted market. That's my barometer of what's going to happen in the market, because they have the least to spend and the most to lose. And so if that's moving, I kind of feel like it's going to trickle up, as I mentioned that other day. I really do think so, because that's the hardest market to get moving when it's the most dependent on leverage. So I think it's happening, but I don't think it's happening quickly. I think it's going to take a slow burn to come back. But I do think people are absolutely gaming the system. They're looking at how much things have reduced.
They're the election dip and the rate dip.
100%. It's an opportunity to get in when nobody else can afford to, or make it happen, or is not comfortable, or is dependent on that vesting schedule coming due, or that, that hunk of money that they've been working all year for. They haven't got it yet. So the people
Right.
that are getting that value are doing it now.
But it's a volume dip, right? It's not necessarily a price dip.
I think it's both. I think it's
You
both.
do.
According to Keeping Current Matters, I'm glad I have it on the screen. They have a chart for that. There's your volume. Home sales went up after 9 of the last presidential elections. That's home sales went up, and home prices went up after 7 of the last 8 presidential elections. So,
John, you know what I think? I think the problem with this particular year, unlike other election years, is, as Jonathan said, we haven't had a rate increase of that sizable amount in so long. I think it forced everybody to sort of stop. And I think the reason it's moving irrespective of this election is because finally they can make the numbers work, because the rents are so egregiously high. So I think that seasonal movement is somewhat reactive to the fact that it hasn't been able to move at all for almost 9 months.
Also, too, I think that it's been 2.5 years since the Fed originally pivoted in early 22, and I think it's been such a long period of time that people that have been waiting for rates to fall, even though it's been underwhelming, it's sort of that time, that I think, this idea that they can refi out later. I mean, one of the incentives to, if you're going to buy at this point, is I think prices in general in most markets are going to be higher, somewhat higher in a year or two. And so the notion of waiting for rates to come down, if you're sort of playing that game, it in my mind, it almost makes sense to, if you can afford to buy earlier than later and then refi out over the next year or two. One of the odd things about this, as we talk about rate cuts, and there's, the Fed has in November a 25 or 50 basis point cut, in December probably a 25, and then 4 25s next year. That's not to say that'll happen, but that's what sort of Wall Street is betting on. However way you look at it, rates will be likely that, unless we have some weird black swan event like another pandemic, rates will be lower a year from now and probably lower 2 years from now. But pricing will probably be
Go up.
higher.
am I that? Wait, I'm the skeptic. What I heard you say was behavior is at the $400,000 studio and in the luxury market. And you're talking a great deal about the effect of rates on the market. But I've been reading that 80% of deals in New York are cash, and 90% of deals in Palm Beach have been cash. So why are you talking to me about rates? I thought that this was about election uncertainty.
It is, but rates are also, another way to look at rates is Fed policy and the financial markets, and the clients that Francis was talking about are looking at the financial markets, and Fed policy is a big part of the financial market performance.
Are they financing these $400,000 studios and those $40 million townhouses in New York?
I think that it's not so black and white. It used to be, right? But it's 60% of the deals right now are, in my opinion, are cash, and it's usually parents buying for children. And as I mentioned, and when we spoke the other day, that a lot of these guys want to keep their money performing because they want to make back what they lost. And so they're only willing to take out a little. And Bank of America right now, you can do a 10-year for 4.8. That's really interesting to people who've been looking at 6.5 on average, or 6 or
Sure.
5.9.
Regular
do it.
people can do 4.8. Wait.
Well, you're going to have to put down a little bit of money, but most of the parents have that capacity to transfer it and make it make sense for them and make it work for them. And quite frankly, because they know they're getting an inherent deal of on or about 27 to 30% value, to them, it's like a no-brainer. If I want
Yeah, and
to
actually,
300 for a bloody studio, why wouldn't I want to own equity and buy a co-op? And that was trading at 1.1, that'll probably go back up to 1.5 to 1.7 over the next 18 months to probably 5 to 7 years. It's going to take 5 to 7 on average to build back up. But I think that's the play. It's like those people
right.
that bought townhouses in the 70s. I got it for 30,000. And you're like, really? Well, now it's 6 million, honey. Capital
Yeah.
gains loss.
Right, right. Also, too, one of the things that's happened in the last couple of quarters is we had, over the last decade, at least that's the data that length of the data I have, the market was a 50-50 cash market, 50 cash, 50 finance. In the last 6 quarters, it's been well above that. In fact, a couple of quarters ago, the end of last year, we had a record 68%. We're almost touching 70% cash buyers. That has really dropped. It's now in the high 50s. It's, close to 60, as Fran is saying. And the reason it's falling is because there is an uptick in financing. It's just, a creative kind of financing. It's not, people are going and financing because the rates are so low, but there's more creativity coming out in financing for people.
Interest fencing.
Yeah, exactly. So, it's an interesting time. It's hard to sort of stereotype what the buyers look like, but we are seeing less reliance on cash, like equity drawdowns from the financial markets. And we've been seeing that for now a couple of quarters in a row.
How fast is this going to happen after the election? Can I set my watch to it that once uncertainty leaves the market, this is a show about elections, does everybody breathe a sigh of relief? 50% of everybody is happy, 50% are unhappy, but the uncertainty is behind us and we all make decisions. Some of them are sellers, some of them are buyers.
Well, in past experience, it was like the next day where we were seeing on the ground in our appraisal practice a surge in activity. I'm not so sure this go around. I think but I think that it'll be noticeable. It'll be a release. There's a lot of restrained or pent up demand right now. I'm not saying it's going to be a frenzy, but I think it'll be noticeable. In November and into December, we track new signed contract activity in Manhattan and
where is it now? I mean, I've been looking at Roberto's. I'll pull up Roberto's charts while you're talking, but where are we now in terms of volume activity, signed activity?
So if we look at it on a year-over-year basis, in the month of September, overall contract activity, all 3 property types that we track, co-ops, condos, and 1 to 3 families in Manhattan are up about 30% year over year. And Brooklyn, although we're not talking about Brooklyn, is up about 50%. So, a year ago was low, so the 30 is, a little bit exaggerated in terms of sort of, twisting percentages, but clearly there's been an uptick in activity. Not only that, this isn't unique to New York. We're seeing this across most of the markets we track in the country, whether it's Southern California, Florida, and New York Metro.
I think the immediate effect is going to be a little bit because of what happened last time. And the election the certification will come later in the beginning of January. I think there'll be an uptick, but it'll be gradual. But once the inauguration happens and bonuses come in and sentiment is changed and there's another interest rate, and the holidays are over. I think next spring is going to be palpably busy, much more so than it is now. And that prices where we're not in a dip in prices, in my opinion. We've wavered 2 or 3% for a while, and they've been fairly flat, even though we've had, below the market, below than average volume and interest rates that doubled. That even with all of that, prices stayed fairly flat. But now that this is the bottom, this is because of that, and where prices did not fall really, like materially, that this is a real bottom. And from here, there is what they're heeding Fran's advice, that now is the time, because it's just going to accelerate.
I agree. That's the case that I'm making. I just don't think the acceleration is going to be some sort of pandemic era frenzy. I just think it's going to be a measurable uptick. The way I think of it is like we're surging back to normal. Is the way I think of it, that we're getting back to sort of normal levels. Manhattan sales are about a little over 10% below long-term norms. I think maybe we bridge the gap in 2025, especially with the notion that rates will probably be lower in the first half of 2025 than they are now.
I'm going to continue to play the skeptic. I think you guys are all talking about the New York market, because if you've decided to move out to Connecticut and you're looking for a house, I don't think you're waiting for the election to decide what to do. If you decided to go buy a house in Darien, Connecticut, you're looking at the 30 houses that are on the market in Darien, or the 60 in New Canaan, and you're not waiting. If something comes up in these markets that have no inventory that works for you, independent of what the Fed did last week, independent of who wins in 2 weeks from now, you're making your move. You must be talking about the price-sensitive, rate-sensitive New York City market, Francis.
I mean, there's no question. The issue is it does impact. It's like the chicken and the egg. Connecticut owners aren't interested in selling if they have to now bite down on a very different rate, and they do need the leverage. I mean, we saw a total protracted segment of the market by 58.3% between the $4 and $5 million buyers. There was just nothing going on. It dropped by almost 54%. That's nuts. So that tells me it's the same kind of buyer that you're looking at in Connecticut. And the sellers that have to pony up to sell it really want a ridiculous number, because for them to bite down on taking a rate that's higher than 3.5 or 2.7 hurts, has to make sense. And I think that's part of the chicken and the egg. But in the city, you have a rental component that was up 42%. We're now seeing a softening. We're now seeing concessions. I'm offering concessions. People are sort of unsettled. They don't want to pay $5,300 for a studio, but they also want what they want, and they want it to be perfect. So it's that dilemma. And I think people that are finally entering in for the first time will be much more accepting of a rate in the 4s than they might be in the 6s. So I think
You're offering concessions in the rentals or on the for sales?
Concessions in the rental. You're off peak now. You're in the colder months. No one's bidding it up in the sort of more luxury rental side. You have to really make it worth their time.
2 weeks only, right? And then the concessions go away, right?
I'm not picky.
No.
I bring it on. Let's work.
What does that mean? No, Jonathan. What? Wait.
No.
What?
So this summer, and I'm talking about the city to be clear, rents through September have fallen in 5 of the last 6 months on a year-over-year basis for median rent. We are in, prices peak in the summer and then slide a little bit in the fall. And that's what we're seeing, but we're but we're not setting, on a year-over-year basis, the numbers are generally still down on a year-over-year basis. We're seeing softer rents. We are seeing an uptick in concessions. What's really interesting, though, despite all that, about 1 out of 5 rental apartments is leasing above the last asking price by the landlord. So it's confusing.
I
And
am very confused. I'm hearing about
confusing
concessions.
market.
I'm hearing about many of them going above the last asking rent. How do I square this? I mean, and we're just talking about the New York. Is it
yeah, just New York. But
multiple markets in New York? Some things are hot and some things are soft.
Yeah.
We cover Manhattan, Brooklyn, and Queens, and in aggregate, when you blend it all together, each borough is seeing declining prices and has been for the last few months on a year-over-year basis. So it's not that, the seasonality is controlled for. And we're also nationally, we're seeing it's the same idea. It's not that rents are declining nationally, but they're not rising as quickly as they were. And that's been going on for the last 6 months. So it's really been a softer rental picture, but rents are still elevated. When we say rents are sliding, doesn't mean they're correcting. It means that they're not pushing all-time highs, but they're still very high. I mean,
I
that's
think the blended average for the rentals went up to $103 a foot from 75.
yeah,
Like, really?
yeah.
But then it sort of softens down just because you're baking in the incentive, the concessions to sort of bring down that absolute blended.
That
But
$500,000 studio you just talked about sounds like I could rent that out and make it back easily.
Well, we tried it, and a building that was getting on average 5,300, and we landed up having to bring it. I suggested bringing it down from the get-go, and we rented it below that. We didn't get the full price, and we offered a concession.
Fran, you have no investors in the marketplace.
Yes, I do.
You do in order to rent it out.
Yeah, I have a gentleman who's bought multiple units in one particular project I worked in, and his rental is off the hook.
But hang on. But in order to make that right now, for the last couple of years, the numbers have not really worked. You have to put down like 60-70% in order to just break even.
But they have worked because the rates were so low on the mortgage. Huh?
Not before, not now.
Oh, before. Yeah,
That's why I'm
now
saying
it's tough.
You actively have investors, because I don't have any investors.
Okay, sorry. They're moving to more townhouse product. They're going to do 2-income family. It doesn't make sense unless they can do a co-op, and the co-ops are too difficult to even go there. So, it's a bit of a shit show, yes. Bleep, bleep.
We have Fran on, it's like Morse code.
All right. I have a clip I want to show from Boroughs and Burbs 111, navigating the French Riviera. I'm going to ask you about the foreign investor after I show you this clip. This is one of my favorites.
And I'm not partisan because I am not in American politics. But in general, when there's a change of policy in America, a change of president, we get a big inflow of either Republicans when it's the Democrats that get in, and a big flow of Democrats when the Republicans get in. And I'm talking about a big flow. I'm talking about numbers in the 10s and 20s of people who just don't want to live in the States with another party. It's fascinating. We don't have this problem in Europe. And I hope it resolves itself at some time or another in the near future.
So if I check my watch, we have about a 1-year opportunity before the next American election where I can go in and get a screaming good deal in the south of France with Philip and Eve. And after that, all my American buddies are going to come over and drive prices up. All right, so talk to me about the foreign investor in New York. And because we've been talking about the effect of uncertainty before the election, but we don't talk about until I went to France there, we didn't talk about what happens after 50% of the country is bummed out. And I don't think that's understating how people are going to feel on Wednesday morning. So talk to me about the foreign investor and what are they also affected by the uncertainty? Are they leaving? Are they coming in? What's going on?
Go ahead. Go ahead,
No, you go.
Francis.
No, you go.
I was just going to say that the dollar is too strong. So yeah, you'll have an ebb and flow based on who likes who or whatever. But the dollar is, almost in parity with the euro. There's no sort of, discount. It's not that there aren't foreign buyers, but there's not a flood of that. And I wouldn't think after the election, the dollar, is still going to be about where it is now. And you're not going to have a run on foreign buyers. But perhaps a little bit more activity just because
are some of your New Yorkers thinking of going to France, going to London, going somewhere else if the election doesn't go their way?
I think you get a standoff from some who are really politically offended by some of the policies. But, I hate to say this, but at the end of the day, it's still one of the best places to deploy cash. It just is. It's much more user-friendly than most places. Although they are trying to incentivize in Italy and Croatia and Poland to get people to come and make it a tax-free, like Portugal did. It's all very desirable, but there's a little bit less of efficiency to that. So I think the deployment of cash still becomes king to the main hubs, New York, Paris, and London. So yeah, I mean, people here still want a piece of the action, but I think they are really offended by some of the front runners. And I think that's going to either make it opportunistic for the others or basically say, no way, I'm not even going there until this place gets their act together. I don't know. Just depends.
Yeah.
It's going to be a mutiny either way, if I had to guess. Doesn't matter who wins. No one's winning on this.
Roberto, what's the mood over the local election? I mean, the
no one votes. No one votes. So it's
the presidential election is what everybody's been talking about, and that looks kind of 50-50, but nobody saw all this controversy coming in with the New York mayoral election and how will New York be run, and will New York be are New Yorkers feeling confident about the New York situation, or because of controversy and because of all the uncertainty in New York politics, are they saying, I'm down to Palm, I'm looking at Florida, I'm looking at Texas, I'm looking at LA?
Oddly, none of my clients, it's not even a concern. It's not even a conversation about the local politics. And it's reflective in the turnout for local politics, which is abysmal. I don't know what the percentage is, but it's abysmal. And but then everybody complains because everything's so far left, and money's flying out the door, but they don't vote. So I don't know.
They think that it doesn't matter who's running New York, that New York will just continue to motor on forward despite the leadership. Because
I don't know, there's so much money here and it comes from everywhere in the world. So it's a bit of a force that's almost impossible to stop. But the local politics is a real problem here, I think.
Yeah, I just that's two conversations.
Yeah,
it's politics, or do politics in New York dramatically impact the housing market? And I would venture a guess that even with the corruption scandal with the current mayor, that is not will not have a measurable impact on the local real estate market, right or wrong.
It's more the policies that have been at bay. I mean, I think Horchel was supposed to make an approval or not on removing LLCs last year, right? And that would
Yeah.
have been the demise for, foreign investment. Just another one. Once you take the SALT deduction down, it's like anything else to revenue us.
Right.
So,
And
I think
it's important to remember that more than 50% of New York City's tax revenue is real estate related. And it's such an important component, but at times, there's a feeling of concern coming out of Albany about the the sort of cavalier way that real estate is treated in the city when it's such an important revenue driver. But on the other hand, when you just look at the housing data that we've had over the last 2 or 3 years in terms of rental transactions, rental activity, sales activity, it certainly is not a bleak picture for real estate at the time.
Remind me, what was the effect of the local SALT tax or the SALT tax and the local decision to institute a millionaire tax? So was the Pieta tear tax, did it have an effect?
I mean, mansion tax, transfer taxes went up to as high as 3.5% on mansion. I mean, like, those are huge hits. I mean, Ken Griffin paid, serious gabillions, and I think he was looking at 7 million on friction costs alone.
Yeah, just for the tax. Right. Yeah, 239 million. I think his mansion tax transfer tax exposure was like between 7 and 8 million for that.
That's a hit.
The mansion tax at 25 million is around $1 million.
Yeah.
I mean, that's
gotta hurt.
Yeah.
Where's the respect?
So
I think about Griffin.
So the overarching
60-degree views of the city.
The overarching question is, does policy have an effect? Does it matter that Trump is proposing to end the SALT tax? Does that matter? Do people say, oh, if he wins and they repeal the SALT tax, that will affect the New York City real estate market profoundly?
A huge amount. And it's so bizarre to me because real estate is his backbone. So I don't get it. It's the complete counterintuitive approach. It's just dumb.
The tax expires in 2025 anyway, so he's just like accelerating. I don't know whether it would renew. I don't know whether he'll have Congress behind him because it's not a presidential power to levy a tax or to undo a tax that is a law. But it's that is actually the confusion, right? That we were talking about at the beginning of this call, is that there's a lot, we're on the home stretch, and there's a lot of policy stuff that's being thrown against the wall, and it's being sort of, replicated, and it's creating, sort of a level of misinformation or misunderstanding or stereotyping or whatever it is. And that is what is causing consumers to pause. And historically, that we're in the sort of the moment of truth the next couple of weeks, and there's going to be a lot more of it before this thing's over.
So
all right, I want a specific number.
But hang on a second. So let's just say, just love to get your guys' opinion. Trump's president or Harris's president in the spring, what really fundamentally will be different? What metrics will be different? What will be different? What is an actual concern, one way or the other? Because it tends to me, I always think it's kind of like much ado about nothing. We've got our own lives to live, and it becomes a very micro situation for ourselves, aside from SALT, rental laws, etc.
I don't think anything changes. On the pure real estate play, forget all the other, the other 90% of it, but the sort of what impacts transactional activity. At least at this point, I can't see how it would be much different.
Fran?
I agree. I concur with Jonathan. The only thing that might change is the optics of, you've got Kamala sort of trying to give entry markets around the country a $300,000 adjustment for, I don't know how the policy is structured. So it's basically the hope that there would be some sort of concession into the entry of that purchase segment. But generally, I just feel that we have the highest amount of dollar volume generated in real estate in the country, and it sort of disseminates throughout everywhere. To cripple that is, to me, taking away the capitalistic component of what makes America so brilliant. And you either love it or you hate it. People are still running to the shores to get here and still badmouth it outside of both sides of their mouth. So there's something there to that. And I, as someone who comes from a different country, I love that capitalistic opportunity. I think it's what's so brilliant and amazing. And I'm sad when I see our city specifically getting targeted and crippled a little bit. And it makes it, we're like limping. We're like, we got this. But it would be nice to see us flourish a little bit again. I think we've earned that. I think we've shown that we can rally in the most dysfunctional times. And I think, no matter how much people want to lambaste it, it still outperforms expectation nearly every time.
Here, I love that. That's well said.
If we eliminate the SALT tax, if we allow it to expire in 2025, which Trump says he's going to do that, I would think that would have an immediate and profound effect on your listings, Francis.
Why?
$1 million.
Because they can't write off up to 10,000 of their taxes.
No, meaning they can. I think what it means is I can start to write off more than 10,000 for the first.
Oh yes, sorry, yes,
years.
the other way. Yes.
And if I can start to run it and it can compete as a business where I'm not getting whacked with an extra tax.
No question.
I mean, the average house in New Canaan is paying, I don't know, $22,000 in tax, and now is cut to only deducting 10,000 of that tax. So the average house in this town is getting a $12,000 windfall immediately. And I think that would raise prices in this town immediately. Do you see the same thing in New York? Which is primarily a rental market?
No, I don't think it's a primarily rental market. I think the new generation is primarily rental, but I think there's still a foothold for people who want and buy and flip and grow. And the commodity of space becomes the interesting value proposition for people building up their equity. As it relates to your question, there's no question. No, absolute, without question. People are dying to get breaks where they can. It's just a very expensive city. It's become incredibly expensive. I think our taxes are at, depending on the tax bracket, as high as 68%, or is it 58%? Am I off? It's like 60% plus.
Yes.
Yeah, I
bonkers.
I appreciate the exercise. I just look at it sort of in another way, is that he doesn't have the ability to do that in a short period of time, and there'll be other fish to fry. As much as I think that would be good for the transactional aspect of the housing market, and it just, we can talk hypotheticals all day. I see that as a distant, remote possibility, possible scenario.
You don't think you don't think that it's getting rolled back?
No,
New York
because
depends on it too much.
It's not. It's
with either president.
Right. New York just needs the money too much.
It's gonna roll over, or it's gonna end in 2025. So anyway, so, all the effort that's going to be made to cut it short by 6 months or whatever the expiration date, it seems like that's
Extreme.
political capital that's not going to be spent. It's going to be on something else. That's my feeling. It's sort of a false narrative in my mind. It's positive if it happens to the housing market in the U.S. in high tax locations, especially the Northeast and California. But I think I'm just not a believer that that's even remotely going to happen.
All three of you are bullish on the real estate market.
Always have been. I've never
Really?
seen anything come through the way it has.
Yeah.
But Harris is proposing to raise the capital gains tax. Trump is proposing to instill new tariffs. I think Jonathan was quoted as saying the effect of raising of tariffs is going to harm real estate.
Well, it's gonna create
inflation.
runaway inflation, and mortgage rates will be higher. So it doesn't make any sense, and
So
again,
both candidates have proposed policies that will have a chilling effect on real estate, and yet all three of you are bullish.
yeah, I'm bullish about the next several years because we're drifting into a lower rate environment. We're also we have a recognition by both parties that housing is distorted. Affordability is at all-time lows or near all-time lows. A lot of this is was created by the Fed by keeping rates too low for too long. They're trying to sort of look better in this effort to lower rates, but the economy remains resilient. And I've lived and worked through some pretty dark times in the economy. And the problem that we don't seem to have is, we still have very low unemployment. We have wages that are higher than pre-pandemic. All those are favorable to the housing market.
Always the optimist, Jonathan.
It's also sentiment in New York. In every cycle I've been through, the moment the sentiment starts to change, and all of these factors are positive sentiment items, and we've been kind of stuck for almost 30 months, just kind of in this little cage. And New Yorkers just want to, there's cracks are happening. People get a new job, people have to, they have kids, whatever. Cracks are happening everywhere. But the moment, and there's always this moment, you have a buyer like, what just happened? All of a sudden, they're in bidding war. Stuff like that. The sentiment changes so fast, and we have had such a long gap since we've had a moment like that, and it is coming. And
but I just told you both candidates, one's going to tax the crap out of you, and the other one's going to tax the foreigners. You're getting inflation. Are you still believing, like Jonathan is believing, that the market is inevitably going up after the election?
I don't know. No, go,
despite those headwinds.
I was just say that, so that the part that your economics class in school didn't teach you is that, with supply and demand, inventory is still the distorted metric in the world, even with an uptick in inventory relative to the record lows of a couple of years ago. In most housing markets are not bloated with supply like we've had in other periods of time. Bidding wars are still elevated across most of the markets that we cover. They're not as high as they were a couple of years ago during the frenzy coming out of the pandemic, but inventory, more inventory combined with pent-up demand being released, in my view, creates more sales transactions. I think of this as when we were cooped up during the lockdown and, you know, the year and a half after that, we went on a, you know, sort of the world went on like a vacation travel spree because everybody was locked up and looking and saying, hey, you know, I'd really want a better house or whatever. In this go round, it's more like, hey, you know, and I've used this on your show before, you know, the married couple that has triplets and they, you know, they bought a 1 bedroom just before the Fed started raising rates and they've been holding out as long as they can. I think that, you know, their patience for waiting is been sort of, you know, battered. And we're already seeing evidence of this right now. We're seeing more inventory coming in because the seller resilience is weakening, and we're seeing more contract activity because buyer resilience, you know, waiting for lower rates is weakening. It's already happening. I think once the election occurs, that's sort of another step or another level of activity. I just don't think it's going to be this crazy frenzy that we saw during the pandemic.
It's almost as if the hyper pullback pushed everyone into overdrive. It's almost like people went the other extreme. And now this market is what probably should have been the market after coming out of that. Much more measured, slower, much more put your toe in the water and check it's not going to blow up, and then build up to 2021, which was the other way around.
Yeah, no, I think that's a great point.
All right. If I come to you, Francis, Roberto, with my $50 million portfolio, and I say I can make 6% in the market, I mean, and interest rates are pretty good. I can buy stocks and bonds. Can you get me a return, or have I already missed the boat with decreasing rental prices in New York? Prices have already started to rise. Can you help me as a buyer deploy that capital and get a more than 6% return on my money in New York, in the New York market? Or is it just a market for people who want to live there and be there?
I would be doing you a disservice to predict a future market. But if I look at the historical cycles and I bake into that, I would say, depending on where I put you right now, some of the best deals are going to be in these co-ops that are on Fifth and on Central Park and on these main hubs and those locations. And there's such a finite amount that will ever be built. So to me, if I can nail it properly and do it, absolutely, you can make way more than 6%. But you have to be patient. It's a long hold. It's not a fast performing stock. This is not, it's a slow burn, but I think I've done it, I've watched it, I've created it inherently, and I feel pretty good at being able to see when to take action. And it's always against the market. It's never when other people are buying. There's no value there, in my opinion. That's for buying to live. The people that are buying to really make a performing asset work is to be buying these times and during COVID when we were in lockdown. That's where I did some of the best value plays for clients who were willing and were trusting of the fact that New York would hold relative value and that the world was not ending and that the city was still viable.
So if I call you and I say, I'm a patient guy, I want the next mispriced New York asset.
There's plenty of that, John.
Call me when the sky is falling. That's it.
Are you
my buyer who bought at the best time bought in the spring? It was like April of 2009, when the market literally, I think the Dow hit like 6,800, and he bought.
Yeah, but Ford stock hit what, $3 that week? I mean, there was a lot of opportunities when the sky is falling in the market. And so what I'm wondering is, you know, are you seeing screaming good deals in the New York market, mispriced assets that you can get me in as long as I can hold, as long as I'm a patient seller?
Absolutely.
And you like Fifth Avenue co-ops, Francis.
I didn't say I like them. I say that there's a value proposition there. When I see what's going on in the co-op market as a general matter, I mean, those 28 contracts and 13 of them were above 10 million, only 3 transacted. And I think that's part of the change in the buyer profile of, I don't want to have to spill my guts in front of people. I really don't like not having as much control. And I really don't know if I can meet expectation, and I don't want to feel like I'm not enough. So there's a lot of that. But there's also a lot of liberal co-ops downtown in main locations in the West Village and Greenwich Village and Lower Fifth. And I mean, there's also condos that are getting destroyed right now that paid too much at the height of the market that are having to soften because they've got to get out. You know, the summer was a very interesting time for people. I mean, I took my product off for the most part because I didn't want it sitting, and the people that had to sit were the ones that really have to sell. So they will take the opportunity to hear what you have to say, which means you can price gouge nicely.
Are you advising your clients to get in now or wait for the spring market if I'm going to list? Should I take my time, renovate, perfect the presentation, or is there a sense of urgency that I got to get my product on the market now?
There's 2 thoughts. One is, this is a market where people want finished product. They can't afford it. It's too expensive. The inflation costs associated with renovation was once 1.5 is now going to run you 2.8. It's too expensive. So for the most part, not every, people want it done, or they good enough where they don't have to do much right away. I definitely think that that short supply of inventory is the opportunity to test the market if it's a good and well done product. We have a listing right now. It's beautiful. We've had over 30 people. But it tells me that people are still, is this the best my money can do for me? And eventually we'll do it, but it's a slow market. People are assessing what's the best my money can do for me. That is the most key question.
Fran, how do you think that would perform though if you pulled it and you brought it back, you know, late March, April? I mean, impossible to say, but
it's impossible to say. I think people think we know, but we don't. We don't really know. We think we know. We hope we're right.
Jonathan knows.
I know.
Jonathan knows. Rub that crystal ball, honey. Let's go.
It's held together with duct tape, as I always disclaim, but
A couple of divots from being thrown.
absolutely. Yeah, no, but you're just describing the election, you know, sort of sentiment, you know, that's sort of, it's just another variable. It's just a variable that's hanging over everybody that goes away. There's other variables, but that is sort of the universal one that's across the country, and we got 2 more weeks of it.
Yay!
According to your charts, we're in that negative 2.6.
John's going there, Jonathan.
That's it.
But we're heading into the positive 5, positive 6, and in LA, positive 10% year.
Yeah. That's what history tells us. You know, is that an off year versus an election year, they're different performance, and they're going back 2-3 decades or more.
So I need to sell my take my winnings from the stock market, call Roberto, call Francis, put it to work before the 10% increase, and hope for the SALT tax repeal.
Well, you can do whatever you want, John. I'm not going to stop you.
That's Jonathan's very polite way of saying.
hey,
Well,
guys, thank you.
Thank you. This has been an awesome show. Thank you,
Really
Francis. Thank you, Jonathan. Francis, are you so bullish that you're going to double your already phenomenal business next year? That once the floodgates open, the Katzen team is going to
knows?
2 billion, not 1 billion?
Come on. I have no idea. No idea.
I
The
was
more
shocked that you said that you actually sell a $400,000 studio, and I thought,
I don't have an ego. I think people are really shocked. It's so funny. It's like you're doomed if you do and doomed if you don't. If you do big stuff, then you're too big to do the little stuff. And if you do the little stuff, what the hell are you doing in my apartment? And the bottom line is a good broker should do it all, because that's how you track your markets, and that sort of keeps your feet firmly on the ground. I don't care. I just do it all.
I agree with that.
I loved hearing that, and I wanted to make sure we underlined that you do it all, and you're watching the $400,000 market
You have
and
to.
the $40 million market.
It all speaks to the next tier. They're all part of your journey, right? It's not just one. I'm not just,
Right.
I believe in growing it.
When I called Roberto this week to try and get together, he blew me off because he was working on another $35 million deal.
Excuse me.
So,
Yeah.
It's
You
Roberto.
putting bad vibes out there.
But Roberto, that's a typical week for you.
No, it's not.
Wow.
It's
All
just
right,
so
thank you, everybody. This has been great. We're
Thank
gonna
you,
put
guys,
this out
so
there,
much.
and I think the
Yeah,
phones
thanks
are
for
gonna
having
ring.
me.
Cheers.
Yeah,
Thank
fun,
you.
always fun.
And
Take
you know
care,
who we
guys.
got next week, Roberto? Dubai.
Yeah, I
We're
know.
doing Dubai with Knight Frank.
Bye. Bye.